Today we'll be talking about hours from UK Social Security collapse and also talk about what to look forward to in the next FOMC meeting. These are the topics we'll be going over today. First of all, we'll talk about UK pension plan, what happened, and then we'll talk about why these funds are at risk. Then we'll cover off NOPEC irony, and then we'll go into how Bank of Canada only hiked interest rates by 50 basis points when the market was anticipating 75 basis points. Then we'll cover off earnings disasters, mainly the big names with Amazon and Meta. Then finally wrap up with what to expect for the next FOMC meeting next week. Taking a look at UK pension plan, the Deputy Governor for Financial Stability actually came out and mentioned that Bank of England had to intervene because the pension funds were hours from disaster before it intervened, meaning, if Bank of England didn't, the pension plans would have potentially been a big carnage, and this is possibly due to the massive rapid increase in yields. And what happens is when bond yield or fixed income yields increase, existing issuance, the price goes down because the return on those are fixed. So let's say you got the pension fund, they bought treasuries or some fixed income asset at like 1%, and then now rates are now 2%. And so what happens is the valuation on those treasuries are not as worthy, and that's what happened with the rapid increase in rates. And so Bank of England, to avoid pension plans having to possibly sell their positions, declare bankruptcy, margin call, a bunch of different possibilities that would make Lehman Brothers collapse look like it was just very small, because the UK pension plan would be much bigger if that were to happen, if that were to go bankrupt. So why are these funds so at risk? And so we're not just talking about the pension funds, we're talking about other bigger funds that have invested in fixed income. And so in my opinion, these pension funds are Ponzi schemes. What happens is it encourages reliance on government instead of citizens saving themselves. So you're not being as responsible during your work life before your retirement, and you're just counting on your pension from the government. And what happens is, as population growth slowed, because after the baby boomers, we're not having as many kids because kids are the possibility of kids surviving is much higher now because of medical advancement. And there's not as much war, there's not as much requirement in terms of labor around a household. And so what happened was population growth slowed, and what that means is and as baby boomers are retiring, the contributors are becoming less and becoming less than the beneficiaries, where the baby boomers are now retired, so they're big amount, and millennials are mainly the ones that are working in the workforce, and there's a lot more baby boomers. And so what happens is the millennials are struggling to be able to have enough input into these pension plans than the retirees are taking. And there's also the lack of yields and higher costs, which payout rate. And what happens is, with artificial low interest rate, the pension funds have not been able to get higher yields from government issue security. That's usually what they buy. And so what happens is, it's all good as long as it keeps going lower, but it can only go so low. It even dipped into negative briefly, but as rates come back up, what happens is their securities they hold fall in price. So when yields are going lower, so let's say they got it at 1%. Now interest rate is at 0%. Even though that, they can't buy any securities at 1% anymore, at least the securities they had at 1% appreciated in price. So the capital gain on previous issuance as yields go down helped out a little bit on the yield situation. But as yield increase, now that we have an issue, because there's no longer any capital gain on previous issuance, there's actually a loss. And another contributing factor is, as long as rates are coming lower and the costs are becoming higher, because not only because of inflation, because the payout rate are benched to inflation, even though CP Live, but at least it's a lot higher, right? And what happens is these funds turn to higher yields, and where do they find them? They use leverage. They bought less liquidity treasuries or fixed income, and some even go to lower credit rating, corporate junk bonds. And what that happens is it increases the risk of the pension fund. And as rates go up, the possibility of these higher junk bonds, corporate bonds, their default rate becomes higher. And when that happens, again, that's where trouble lies. So as mentioned before, with inflation, the pension payouts are benched to inflation. That means output is increasing. And with rapid rate increases, the valuation of existing fixed income securities are falling. And what happens with the central bank switching from quantitative easing, which is money printing, to QT, the biggest treasury buyer is now becoming the biggest seller, and they're also the last resort. And so what happens is when the last resort is no longer there, you don't have someone to sell to before, that's the thing with Fed. It was always the Fed put. Don't worry about any drawdowns, just buy, because if anything, you can sell it to the Fed. The Fed will make sure you get out first. And so that's why there's that, with central banks being the biggest buyer and also the buyers of last resort, that's what allowed a lot of complacency amongst investors and also these pension funds. But now they're becoming the biggest sellers. Who is going to buy all this up? And also, government issuance has also increased with record spending. And so all of these brew a perfect storm for all these pension funds, especially because they are also, government funded. And what happens is the government's, responsible for it, but they're also off balance sheet items, for example in US for national debt, you don't see it. And in order to chase those higher yields, in order to satisfy the output because of low artificial interest rate, they chased higher yields with leverage, with lower credit, and so all that has come to now really bite them. So now let's talk about OPEC irony. So Biden asked Saudi to delay the production cuts for a month, so he can go through midterms in peace. Also, not worry about, with oil prices going up, it's not looking so good for him on the inflation front. And, Saudi mentions that U.S. oil, remains higher price because there's a lack of sustainable reinvestment when it comes to oil refinery as part of the supply chain. And so what happens is, regardless of, oil prices have already come down, the oil price in U.S. at the pump remain high because there's a lack of oil refinery. As part of the whole, we are going green, we are, no fossil fuel, let's just, get out of it. And so what happens is these companies, when it comes to, refineries and also oil extraction, these are long-term investment plans, long-term investment projects. And so if you're telling me I will be obsolete in 5 years, I'm not going to put money into, a 10-year payback period project. That just makes no sense. And another thing the Saudis were talking about was, okay, US and EU, you guys are saying, we will be obsolete, we're getting rid of oil in 10, 20 years. But you want me to keep prices low until you are able to get switch out of that transition, meaning not relying on oil anymore? That's crazy. Because then that means I'm just going to sell my stuff for cheap for a long time just so you can have a nice transition, and then who am I going to sell to then, right? So that's the kind of irony part of it too. And the funny thing is, Biden ran a campaign against fossil fuels, like no fracking, but now he's begging for more oil. Well, where's that going to come from? Like OPEC Plus is smart enough to not say yes to him. Is it going to be increased in domestic supply, which goes against his campaign promises? Or are they going to go look for different allies like Iran and Venezuela? It's really interesting and kind of funny. Now let's talk about Bank of Canada. As mentioned before, Canada's CPI month over month was negative in August, but then it rebounds slightly to 0.1% in September. Housing has fallen significantly. I think year to date it's like 20 to 25%. It's a big part of Canadian economy, and so all that might have given pressure to Bank of Canada to announce a 50 basis point rate hike instead of the market anticipating of a 75 basis point. And why that is again, economy is already weak, and if you are to tighten monetary policy, that's a double whammy when it comes to the economy, and it might take longer time to recover. And these are more signs of central bank wavering. So even though they're doing a rate hike, but it's less than anticipated. And also, in terms of future forecasts, they also mention more hawkish statement. And so, as Canada is, feeling pressure to, pivot potentially, meaning like if they do continue this way, meaning less and less rate hikes, or maybe eventually to none, or will they, switch back again and be strong to tightening, right? Those are things that we're looking for to see, which one is the case. And then now let's talk about earnings disaster. So it's Meta and Amazon. After earnings, they were down 20%. So Meta report Wednesday, and then Meta, I think it was Tuesday, Amazon Wednesday. They were down 20%. After, because they report after closing of the trading session, and they were down 20% in overnight trading, which is crazy, like 1/5. And the reason for that is with recession and inflation. Recession decreases the company's ability to advertise, so that hits Meta, and also for Amazon, consumers loses the ability to buy more stuff. Another company was impacted was also Google. They just didn't have as big of a drop. When it comes to their past performance, a lot of it was funded. When it comes to the equity price performance, a lot of it was funded by share buybacks, because they were able to lever up the company. They were able to not spend a lot of money when it comes to R&D, more technology development, but rather just borrow money and buy back stock. And all this stock buyback was a big reason why they had such a big outperformance in the past. But going forward, there would not be as much free cash flow for share buybacks. Not only because of earnings are not as strong anymore, but also interest rates are higher now. And so not only can they not borrow as much, potentially if they have any variable or existing loan that needs financing or variable rate loans, now the cost to finance to pay for those debt is higher, and that means free cash flow will be down. And this is another key valuation point that needs to be taken out of the equity prices. And so, there's a possibility we won't see, all these big growth when it comes to equity prices for tech stocks anymore for a long time. Obviously, this is assuming that Fed doesn't pivot. And even if the Fed pivots in terms of long-term, like next 10-year wise, I don't think the share buybacks would be a big driver when it comes to equity prices going forward. Finally, let's talk about what to expect with the next FOMC meeting next week. So market anticipates another 75 basis point hike in next week. And then one more 75 basis point after, and then we'll see how it goes. But there's a lot of political pressure. Many politicians, mainly Democratic side, is trying to pressure Powell and coming out giving statements, one example being Elizabeth Warren, telling him to slow down rate hikes because it's hurting the economy. And this is especially because the polls are currently favoring the Republicans, and there's a possibility that they may take both House and Senate. Honestly, Trump and the Republicans lucked out. Losing in 2020 was perfect because Trump had an excuse. Economy was already bad turning, I think, 2018, 2019. That bull run from 2008 was already really long and extended. But they were able to use COVID as an excuse to do massive money printing and government spending. And that was able to extend this bull market even longer. And then right before the inflation, which happens with a lag, occur, Trump was able to get out of Dodge. Yeah, he lost the election, but now he gets to blame it on Biden and oh, look, the second Biden takes office, look how bad economy is. Oh, this wouldn't happen on my hand. Even though Trump wasn't the sole reason, but he was part of what brewed into this perfect inflation storm. Biden was just, being used for a scapegoat, which is kind of funny. Even though, yeah, he was for big spending anyway, so he didn't solve the problem, he just added to it. And so the outcome will be interesting. Will the Fed come out at 75 basis point and then maintain the same guidance, meaning, hey, rate hike is not done, we haven't seen anything that will waver us, we will continue to be strong and hawkish? Or will they come out at 75 basis point or even 50, which, will really surprise the market, and, we would expect maybe, a good rally, but then lower future expectations of rate hike, which, it would be a pivot. And with the market pricing in a lot of, a lot of future rate hikes, this, we'll see what happens. If the Fed does show any signs of pivot, I think that would be, in general, good for equities, but equities still have the earnings headwind, but it will be really good for commodities, so oil and precious metals. But if the Fed comes out, continue to be hawkish, continue to be strong when it comes to raising rates, then we would expect bond market to continue go higher, and also even though they have come down from 4.2% and on 10-year, and they have been oversold, but would that push them up again, right? And also obviously for commodities and equity prices, more continue strong tightening Fed would not be favorable. Thanks for watching.